Welcome to Switzer Investing. I'm Paul Rickard, filling in for Peter Switzer. On tonight's show, Jun Bei Liu, the lead portfolio manager at Tribeca Investments, joins me to discuss the impact of higher interest rates and a look back at reporting season. She nominates 3 stocks in different industries covering wine, jewellery and milk that she thinks reported pretty strongly and looked reasonably good buying. And then we'll take a closer look at the RBA tomorrow and also the expectations around peak inflation, when that might be, and what that means to the future of interest rates. That's with Mousina. She's the senior economist at AMP Capital. Now, before we begin, you've got to say that today's market held up reasonably well, notwithstanding the lead from the US. Certainly great performances from our energy, oil and uranium stocks as the world looks forward to, or the world looks at what's going on overseas and fears about the increasing, crisis in terms of energy stocks. So a lot of support for the Australian energy producers in the Australian market, notwithstanding a poor lead from the United States. But I think we're still getting through reporting season, which you'd have to say wasn't too bad. And so that's one of the reasons why the Aussie market has held up pretty well, notwithstanding the lead from the US. And clearly what the US is worried about is the Fed. How hard is it going to go? And did we actually see the bottom of the market in June, or has the rally in July and August been a false dawn? Certainly I think there are more people coming back to the view that the market's going to do a little tough in September, October, traditionally weak months in the market. But for me, the big number comes on Tuesday the 13th of September. That's Tuesday week, when we get the next read on US inflation. And if inflation is trending down again, which is what was showed when we got the July result, I think the market might just start to believe that the Fed may actually be a bit more nuanced in terms of how hard it goes. So that's a really big number. And until then, I guess we might have a reasonably quiet week in store. Okay, let's kick off the show. First up is Jun Bei Liu, the lead portfolio manager at Tribeca Investments. Jun, welcome to the program.
Thank you for having me.
Let's get a quick stack on where you think the market's at the moment. We've obviously had a few bad days in the US. The Australian market hasn't gone quite as far. We seem to be holding up a little bit better up post-reporting season. Are we sort of in that sort of wait period to know whether July and August was a false dawn and we really saw the bottom in June? Or how do you sort of read the market at the moment?
Of course, there's been plenty of people predicting the market is going to have a bit of crash in September, given how strong the July and August was. But ultimately, when you look at it, is that we had a really good reporting season. So the corporate earnings was pretty strong, and the balance sheet is very strong, and consumers holding up. And this is not just Australia, this is the US and around the world as well. So things are holding up a bit better than people expected. And then if you look at the outlook, on the revenue front, we actually have had some of the biggest revenue upgrades in the last 20 years. So the revenue upgrade was very strong for the next 12-month outlook, even though, of course, the cost is going to be higher. We all know what's impacting there. But net, the earnings is looking pretty good for the next 12 months. So for us, this is a pretty positive sign for the equity market. And then on the other part is the interest rate. Clearly, equity market, there's two things. One is earnings and one is evaluation. And then the earnings seems to be holding up well, good balance sheet. And then the valuation, we saw the valuation derate really in the last 6 months, and we feel that is pretty much done. Now the next part is where the interest rate is going to be substantially higher than expected. At this point, it doesn't seem so. I do think.
What about the argument that a lot of people are raising now that maybe we might have not just higher interest rates, but they might stay higher for a lot longer? In other words, with the Fed and the RBA, and they're going to find it hard to get inflation back down to their target levels. So they might be able to bring inflation down, but will we get back to between 2 and 3% in Australia? That's going to be hard work, and so we might just end up with a higher cash rate for longer. Do you think there's much in that?
I think there is a chance. So on that cyclical front, you do have to see what the inflation does. Now, a big part of inflation is material, raw material and things. That's coming off, and even the oil prices sort of come off somewhat, even though, you know, there's maybe a little bit of spike more recently, but that's volatile. So, but everything else together, it's been coming off. Now, labor cost is going to be built in, and that will take a very long time to come through. So that probably means the interest rate does need move higher, probably closer to 3% than the 2% over the long run. So on that basis, it will have to move. So this is when you look at the share market going, what sector do I want to be exposed to? Because uncertainty lies in more economic activity linked sectors like, you know, consumer or, you know, anything that's linked to economic activity. But the outperformance will come from the ones that's kind of more structural growth and that sort of space.
Okay, well, let's go to some companies that did well in reporting season, and companies you like. I think you've nominated 3 in particular. Let's start with Lovisa Holdings.
Absolutely. Look,
let's just explain what Lovisa is. I'm not sure everyone knows.
Sure.
Probably don't buy the sort of jewellery that...
That's right, yeah.
Sorry.
Yeah, look, Lovisa is a fast rollout retail business that sells, I always call it sell trinkets. They sell sort of, you know, costume jewelleries and the like. And mass jewellery. That's right.
Mass market jewellery.
That's right, yeah. So, and it has a huge appeal to, or the mass market, the younger generation. And it's very much, its earnings very much linked to the event driven. So when people go to the races and then they will dress up, rather than, you know, during the COVID when people stay at home, they don't quite so buy that much of the, you know, these sort of costume jewellery. So the business itself is doing incredibly well. It's one of the retailers that is actually still yet to return full earning potential just for the existing business, just because events and things and the mobility, people only just started getting out and about and going to events. So that part of the earning is growing really well. Now, don't forget, this company is actually growing super fast, not just on that, but rolling out a lot of stores. Next 12 months, they're going to roll out more than 130 stores around the world.
It's an international business, right?
It's an international business. So this is the environment where you don't want to buy a mature retailer. You want to buy a retailer that has store rollout, because each store, when you roll out, take a couple of years to mature, and it adds to the organic growth. So you really want to be in those businesses. And Lovisa has demonstrated the ability to, you know, sell through to so many markets. And then, you know, they're in the US, they're in the Europe, and then there's a couple of other markets like Mexico, Italy, potentially coming online in the next few years. So, you know, there's a lot of growth potential, really for a very simple business, and then it really resonate with the consumer. And to us, this company is going, you know, over 20% growth with a very reasonable multiple, clearly more expensive than other retailers, but this is a retailer that will actually grow for you.
And you were pretty impressed with the report?
Yeah, the result was fantastic. Not only they have beaten the very high expectations people have had for them, they also added to quite a lot of earnings upgrade in the next few years with a higher store rollout.
Let's go to a slightly different demographic. Maybe there's some overlap, but let's go to the demographic that likes wine, Treasury wine, particularly premium wines, Treasury Wine Estates.
Yeah, look, this is another company that you know, you certainly want to have your part of your portfolio in, because its earnings not really linked to the economic activity. Has a great brand. A few years ago, gone through challenge of China imposing tariff and things, and the latest result, they have demonstrated now they can sell their premium wine through to other Asian markets as well as, you know, other regions as well. And then the growth in those markets has been substantial. And now they have really fully cycled a period where they used to have the Chinese market, and now they, you know, they're going through growth. They rebase their earning. They are growing from here. This company have very strong balance sheet, and the growth is in the double digits, and it's trading on close to 20 times earnings, and that is not expensive for the current market for that kind of growth that you receive.
I think we might have get a chart up, but one of the interesting things about TWE has been it's sort of been. It hasn't had much downside, right? It fell, and then for the last sort of 12, 18 months, it's shown a really good bottom all the time, right? Obviously, there are institutions coming in and buying it wherever it gets too cheap. So
that's right.
Yeah.
So you remember, it's got all these Penfolds and the premium wine sitting in, and the farms in Napa Valley and in Adelaide. So, you know, sort of sitting on its balance sheet, and then that sort of value, the hard asset value is about $9.50. So, and then share price is over 13. So, you know, you've got a pretty hefty asset value underpinning this stock. Balance sheet is very strong. So, and then this is not to mention the premium label, you know, that premium valuation. So it's very defensive.
It's a slow mover up, because it seems like the market really wants to own it, but they're not. the growth is there, but it's taking, because they're recovering, finding new markets to replace China. That's taking a while, obviously.
Yeah, so for the stock is really, they're already finding the new market. So you should see it gradually grinding towards the, give you that 20% return, because the stock itself is growing at the high double-digit type of growth, and you have a bit of revaluation. So on a 12-month view, you probably see it gradually grinding to higher, but it's not a volatile stock where you see, up 20%, down 20%, that type of stock, because it's very defensive.
Okay, so from jewellery to wine, now to milk, right? So let's talk about A2 milk. Once a perennial darling of the market, price over $20, got to about $3.90. I think in about May. Bounced back last week about $5.80, a little bit low today, but it reported strongly, didn't it?
Oh, reported very strongly. Again, analysts didn't quite expect much result out of them, because analysts all became very pessimistic leading up to the result, because as you know, China is a big market for this company, and then China went into lockdown just a few months before, and clearly things were going to be challenged. But what was amazing, that this company came through, not only reported good numbers, they reported the gaining of market share in that market. For this business, it's actually not about what overall market is doing, because it only has less than 3% market share. It's a market share story, and they managed to demonstrate that they've done that, and they managed to demonstrate that the pricing shelf price has been stabilized, and that's very important to show that it is selling through. Balance sheet has been fantastic. So really from here on, you should see things getting better for this business.
So the market, they didn't react. Took the price side. Some of the analysts haven't got too positive on the stock, have they? Is it because they've been bitten? I mean, like, I remember a lot of analysts loved it at $20, and you see analysts, like, they're humans, right? And when they make a big mistake, as we all do, you sort of, it's hard to turn around again. But I noticed some of the analysts, if anything, reduced their target price following the result, notwithstanding the rally in the share price. That's
right. So I tell you what, you're absolutely right. The behavioural bias of analysts are absolutely very, very strong, especially for companies that's gone up and gone down so much within 12 months. So yes, there's an element of that. And then two is that there's some analysts a little bit think, well, they're trying to be very tactical. These days, analysts sometimes can be a bit short term, trying to be tactical, saying, oh, look, this company's got this license renewal coming through with China, and this process could take 12 months and potentially could act as a cap for the share price. Now, the company's already put in, or the application, in fact, they already started that renewal process 12 months ago, and it's not due until next year. So, we certainly expect them to receive that, but this is what analysts trying to be a little bit more tactical.
And really, A2 Milk is a marketing company, right? I mean, although it has some manufacturing capability, it's really about marketing and sales.
A relationship and everything. Absolutely, it's a brand business, and that's why it can generate such a high return for this business. And then it's in many markets now, a bit like Treasury Wine, in many markets, US here and there. I think there was also another level of disappointment that they didn't get the license, short-term license to the US market.
There had been some build-up that they might follow Bumps, and perhaps with the the US government in sort of urgently trying to purchase infant formula product, but they didn't get a license in the US, and there's perhaps that disappointment in the market? Or?
Yeah, look, honestly, yes, there was a bit of build-up to it, but that market would have meant so little for this business, because this business was entirely built towards the Chinese, the Asian market. The US market, now that if you look at the short-term opportunity, it would have been so minimal to the actual earning to A2 if they do get a license, and also given how many competitors now entering to that market, even if it becomes long-term license, it will be so competitive in that market. The overall margin you can expect from it will be very, very small.
That was Jun Bei Liu, the lead portfolio manager from Tribeca Investments, with her 3 stars from reporting season covering wine, jewellery and milk. Well, the Reserve Bank meets tomorrow and everyone's factoring in a 0.5% increase. But to talk about what might happen tomorrow, but more importantly, just how high interest rates in Australia might go and what that means in terms of peak inflation, is Diana Mousina from the AMP. She joins me now to talk particularly about peak inflation. But let's start with the RBA tomorrow. What are you expecting?
Well, we think another 50 basis point hike tomorrow. To me, it seems like a bit of a done deal with the RBA talking about the need to normalise policy, getting worried about inflation expectations becoming unanchored in their terms, even though I don't think that they are unanchored, but this is what the RBA is worried about, looking to the other global central banks and seeing some of the issues around potentially not going hard early and seeing inflation get out of control. The market's still factoring in about 40 basis point hike tomorrow, so between 25 and 50, but we think 50 tomorrow and then 1 or 2 more after that. So we are probably reaching the end of this rate hiking cycle.
That would take the rate to 2.35%. Just how much pressure is there, do you think, for central banks to follow each other? So we've seen some noises out of the United States about the US Federal Reserve suggesting that they're going to do it pretty tough with inflation. The European Central Bank last week were talking about hiking rates. Is there pressure for, the Australian RBA Governor Phils to sort of be following almost the club of central banks?
The only reason that there would be pressure is because, one, you have the same factors dominating and driving the inflation story, which there are some of these things going on globally, like high energy prices, high commodity prices feeding through into CPIs around the world. And the second is around the impact of the currency from not following the same rate hikes as your other global peers. So if the RBA didn't hike rates as aggressively as they would have, maybe the Aussie dollar would have been lower than it is. And it has actually been underperforming quite a lot this year, but that's only because the US dollar has been so strong. So that would factor into the RBA's thinking. But I think for them, that it's more just that they're worried about the inflation story and that they want to get inflation under control.
Okay, let's talk about inflation. So how high will inflation go in Australia?
Our forecast is pretty consensus at the moment. We think it will peak at about 7.5% on a year-on-year basis by the end of this year. The RBA is somewhere similar, and so is the Treasury, and the consensus of economists is also around 7 to 8%. The risk is that you see energy and commodity prices go higher, which will push up the rate of inflation. So maybe our forecast is too low. But I think that over the next few months, what we're actually going to see is inflation will come down quite quickly from that peak rate after we get it in December, in early 2023. I think inflation will come down quite quickly in Australia because some of those key drivers like energy, petrol prices, food, they will all start to come out. And we can see some of those supply side issues and pressures on inflation becoming a lot better over the last few months. Our inflation indicator has been falling quite dramatically over the past few weeks and months really. So I think it is a sign that inflation is set to slow. The risk is
So what do you look at there to, you said your indicator, just what are some of the factors you look at there?
So we've built this inflation indicator that looks at some of these supply side pressures that we have going on at the moment, the semiconductor prices, commodity prices, shipping costs, container costs, freight costs around the world. And then we also have an inflation indicator that looks more at capacity utilization and spare capacity. The supply side indicator has been falling for a number of months and the fall is accelerating quite a lot. So that's good news for inflation over the next 6 months. The risk is that in the second half of next year, you'll see this dramatic fall in annual inflation, but it will still remain high in annual terms at around 3 to 4%. So higher than what the central banks would like, which is 2%.
So what does the RBA do with it has a target of like to see inflation between 2 and 3%. You're saying that when inflation does fall, it's more likely to be sort of 3 to 4%. Does that mean we're in for a long period of higher interest rates? What do you sort of think that means for monetary policy and potentially impacts on the equities market, I guess share market as well?
Yeah, so I think the risk is that in the next 6 months, we'll see share markets becoming more optimistic around a potential pivot that the central banks will do in terms of not being so aggressive in rate hikes, and they'll see that inflation is starting to come down and equity markets will get excited by that. But then the risk is that the RBA will actually have to do more hikes later next year. I mean, we do expect cuts actually from the RBA next year at this stage because we think that they're over tightening at the moment. But if inflation stays at that 3 to 4% band, then the risk is of more hikes into next year, and that could be taken negatively by share markets.
So we're currently about, if you're right, 0.5% tomorrow, 2.35%. So sort of peak cash rate this year, where do you see by the end of the year?
Probably somewhere between 2.6 to 3%, which
Right.
is still a lot lower than what financial markets are pricing in. Markets are pricing in a cash rate peak of between 3.5% to 4%. It moves around a little bit.
Yeah.
And the consensus of economists, I'd say, is somewhere at about 3.5% as well. So our expectation's still lower. We don't think that the economy can sustain a cash rate much above 3% on a sustainable basis.
Okay. Now we appear to be lagging the US. I mean, we had some data there last month where US inflation went down. We're expecting another read in a next Tuesday week, I think it is, from the States. Are you expecting, has inflation peaked in the US as well?
In the US, we think inflation has peaked,
Right.
based on some of these indicators around the supply chain costs and pressures. In the US, though, I think, again, similar to Australia, that inflation will come down quite quickly. And that, because we already see the peak in US inflation, I think it will start to come down from here. But you've also got rents going up in the US. Wages growth is very high in the US, much higher than it is in Australia. It's double the rate that it is in Australia. So you have these other factors that will keep inflation a lot higher than what the Fed would like to see. So I think inflation will also be sticky in the US between 4 to 5% next year.
So I guess sort of summing up, inflation's peaked in the US, will peak in Australia in a couple of months' time. Will come down, but we'll be at slightly higher levels than we might have imagined, which probably means higher cash rates in the longer term. Is that
right.
sort of?
You've summed it up perfectly.
I've summed it up readily. Okay, well let's see if you're right tomorrow. I think they'll go 0.5%, but we'll find out at 2:30 p.m. That's Diana Mousina, from senior economist with the AMP Capital. Her thoughts about inflation and what to expect tomorrow from the Reserve Bank. That's the show for tonight. Don't forget you can get more information at switzerreport.com.au. And in particular, I give my view on A2 milk, and you can see whether I agree with what Jun Bei Liu had to say, what investors should do, and potentially what traders might look to do as well. So that's switzerreport.com.au. Thanks for joining us. See you on Thursday.